Good morning. It's Friday, February 26th. I'm George Corrali, and this is the Market Minute, helping you to become a better investor. The stock market got off to its worst start in history this year, creating a great deal of angst for most investors. Here's a chart of the S&P 500.
The S&P 500 made a high back in May of 2015. Here you can see a 12% decline. This was the August low here. This was pretty intense. A few weeks later in September, the end of September, we tested the bottom. Here's a double bottom, and then a strong rally, and then another subsequent decline. So at the low, we were about 15% from the May 2015 high. So we've had two double-digit declines in 6 months. It's been pretty painful, but we've rallied pretty sharply from that February low. Here's a chart of the major U.S. indexes as of February 12th. The red bar represents the maximum decline, and you can see that the Dow Jones Industrial Average fell by almost 15%, the S&P by 14%, the tech-heavy NASDAQ by 19%, and the Russell 2000, which is an index of small-cap companies, fell about 26.5%. This last chart is a snapshot of the major world indexes as of February 19th, about a week after the recent low in the market. And here you can see the S&P 500. Again, the red bars represent the maximum decline. The S&P 500 fell by 14%. The UK stock market index fell by 22%. The German stock market index fell by almost 31%. The French stock market fell by 26%. The Japanese stock market fell by 28%. The Chinese stock market fell by almost 49%. The Hong Kong stock market by 35.5%. And the stock market in India by 22.5% or so. So you can see it's been very difficult conditions overseas. And all in all, the U.S. market has held up relatively well to date.
So rather than focusing on the turbulence, wondering if you need to do something now or what the market may do tomorrow, it makes more sense to focus on developing and maintaining a sound investing strategy. Following a solid plan designed for a period of increased volatility will likely allow you to effectively curb anxiety and its deleterious effects on investment decision making. Here's an effective 6-point investing game plan for a likely more volatile 2016. Number 1, have moderate equity exposure to stocks. You should always own stocks, but the key this year is to scale back exposure when stocks rally hard and increase exposure when they're getting beaten up. Generally, portfolio stock exposure should be below the upper limit of your potential equity range. Number 2, emphasize liquidity throughout your portfolio. Invest only in liquid securities, assets that can be converted to cash quickly and with minimal impact to the price you receive. Don't purchase investments that lock your money up for years or require a substantial cost to exit. If news turns decidedly unfavorable in any particular asset class, you need to have an exit. Non-publicly traded real estate investment trusts, for example, which have been sold to thousands of investors, would fit the definition of an illiquid security. Number 3, own the right kinds of funds. This is no time to own funds based on broad-based stock indexes. If we're in a bear market and the stock market eventually goes down by 25 or 30% or even more, your index funds are going to perform similarly. And if the slow growth environment we're in right now turns into a no growth environment, every economic sector will turn intensely competitive. The weak players, which are included in index funds, will lose market share and profit margins will shrink, sending share prices of those companies disproportionately lower. A low volatility fund would be one example of the right kind of fund to own. Number 4, utilize tactical strategies. Include a few specialized funds in your asset mix, which are designed to be productive in weak markets. Examples would be market neutral funds, long short funds, and dividend focused funds. Many of these funds are outperforming the broader stock market indices this year. Number 5, consider precious metals. Although the metals have been out of favor for quite some time, the economic woes sparking turmoil for global equities have been a boon for the metals as investors pile into safe haven assets. This sector has historically attracted frightened capital from around the world, when headlines feature terrorism, armed conflicts, currency wars, or even deflation. Exchange-traded funds are a cost-effective way to add precious metals to your portfolio. Just remember that this sector should only represent a small percentage of your overall portfolio. And lastly, number 6, be strategic when purchasing bonds. Bonds are the classic defensive investment when stocks skid. But the tricky aspect of today's global bond market is that central bankers have suppressed interest rates dramatically. In fact, Europe and Japan now have negative interest rates. So you need to be strategic when purchasing bonds and/or bond funds in your portfolio. High-yield bonds are probably going to be under pressure if the market resumes its downtrend, so they should largely be avoided. And you got to keep your eye on the 10-year Treasury bond. You know, watch those yields. If a couple of weeks ago, the yield was 2.5%, and now it's 1.72% or so. So right now wouldn't be an ideal time to add bonds to your portfolio. But should that yield head back up later this year, and we get back to 250 or 275, that would probably be a good point to add some bonds to your portfolio. So to summarize,
number 1, have moderate exposure to stocks. Number 2, emphasize liquidity throughout your portfolio. Number 3, own the right kinds of funds. Number 4, utilize tactical strategies. Number 5, consider precious metals. And number 6, be strategic when purchasing bonds.
so nothing causes investors to question their strategy and worry about their money like dramatic moves in the markets. Instead of making poor decisions during a big panic decline, just say no. Market volatility often leads to outstanding investment opportunities. You know, sometimes we are our own worst enemy. The human mind is built to be anxious about the unknown. By following a sound investment strategy, you'll be better equipped to ride the ups and downs of the market without making impulsive decisions that wind up hurting portfolio performance. We are monitoring the markets and your portfolios closely, and we'll be sure to update you if and when needed. Thanks for tuning in to the Market Minute. I'm George Corrali. We'll see you back here soon.